All right. What's going on, everybody? Happy Friday, huh? There's no rest for the wicked. Yeah, orderly. Well, we got through VWAP. Now we just need to break low a day, which is right above yesterday's high, and that can get us started on the halfback of yesterday. Yep. It's worth taking a look around the broader market and kind of having a discussion about where we go next. But we did have some topic requests, so I kind of wanted to get into that a little bit. Today is a good one for the sideways discussion. We always got new traders, and some of them focus on where should I get in and what direction should I go, that kind of argument. And I was talking to somebody today about trading in a range, and when we were talking, the person had just gotten in on that doji right there. They were on a 1 minute. That's what pretty much what they sent me in the picture, and I believe they were going long. Yeah, they were going long here, and they were worried, right? So think about what you are doing when you're trying to get a trade, and why or why not that might be a good spot to get in, or why maybe you might want to wait for something else. In the trading world, one of the things that I had learned to focus on is recognizing where you have edge, chances that you're more right than wrong. And you can get into candle patterns and indicators and continuing momentum, trend, all that good stuff. But some of the basics just come from, if I was to get into this trade, long or short, how would I recognize that I am wrong? At what point? The textbooks would say, well, if you go long here, going beneath this low would tell you that your long trade is probably not going to work. And by long, I mean just getting back up here to the high of the day. That would be the outside target for the long trade. Can I get in here and get up here? Until we break this low, we really won't know for sure that this entry to go long isn't going to work, right? Because we could fade down here and still not break that low. And we could mess around for a while, and then eventually we could make it up there. Yay, the trade worked. So we would not know that the trade was a bad trade, or that it was a trade that wasn't going to work, until or unless or at least we break that low. So when you go to get in, you really have to consider that depth and ask, am I really willing to hold it all the way down to this depth and then below that depth, just to be able to define that my trade has chances of succeeding or not? Well, when I ask myself that kind of question, the answer is heck no, I don't want to hold it that far. If that low is the qualification on whether or not this might or might not be a good trade, then I'd rather get in closer to that low. I mean, it's kind of captain obvious, but there it is, right? You'd be better off getting in near the low to go long, because if you are wrong, you'll be able to recognize you're wrong cheaper, because just moving that much and breaking the low and saying, yeah, I got to get out because we were in a new low here, would be less costly than getting in here and having it go all the way down there and then break the low and then saying, yeah, we got new lows on the day. I guess my long was bad. I should go ahead and get out. So when you're evaluating the trade, before you even go to get in, it really does help to just ask that basic question: where would my trade not be a good trade? Where would I be wrong or less likely to succeed? All of this sounds really obvious because I'm using a very obvious situation. Sometimes they're not so obvious. Sometimes it's something a little more complex, like, hey, earnings is 2 weeks away. All right. You go to get into a trade, swing trade, everything looks great. Then you get in and realize, oh, shoot, it's got earnings or dividend. or investors day conference or any other thing that can interrupt the trade that has nothing to do with the one thing you were focused on. Maybe a particular candle pattern, or they had news today, or it just ran really far. So try to find the answer to this question before you even get in. At what point would I consider this trade no longer a good trade, a valid trade? Put whatever word you want in there. At what point would I no longer want to be long or short because my chances of success have diminished significantly? And that would be your line in the sand. If the distance to that line is more than you're willing to pay, then you know that you don't want that trade. Simple enough. If you can't answer the question before you get in, it's very likely that you shouldn't get in, right? Because if you can't define what your loss is, if you can't even define what constitutes the good versus the bad of the trade, why would you want it? Why would you even want to mess with it? So it's something to consider, and it's a part of the review process too. You take a trade, you're done, you're out of it, you go to journal the trade. You can work backwards, start asking that same question after the trade was done. At what point did I recognize the trade was bad, or that the trade was slowing down, that you should have got out sooner or maybe held on longer? It's a part of doing that same thing. So it's something to think about. To answer questions is a lot better than memorization techniques or trying to um, mimic or mirror something that you saw somebody else do, or just hunting for one particular pattern, signal, or setup. They have different words for that in psychology, but if all you're basically trying to do is mimic what somebody else has done, then you're not learning how to trade. You're just learning how to hunt for a particular signal. If A, then B is how I usually refer to this. So, for an example, a 5 minute open range breakout. It's a nice strategy. I really like it. But if all you know about trading is I'm going to draw a box around the 5 minute candle, and when it breaks out, I'm going to get in, you don't know anything about trading. All you know about is this box, and when it breaks out, you should buy it. You would want to add a lot more to the entire situation, like how to read price, how to read reversals, how to read different candle patterns, how to evaluate what's happening in price to make a more informed decision about what you want to do, go long, go short, go sideways. So when you're trying to grow as a trader and look for new things to focus on, look for new ways to answer the question, what has been going on to get us to where we are now? And from that, what do we think is going to happen next? I can tell you guys, there's just days where I have no idea in the world what's going to happen next. I mean, a lot of times I have a pretty good idea. Doesn't mean I'm right, but at least I have a theory. There's some days you won't even have a theory. You just won't have any freaking clue. Then just sitting there like, I don't know what the heck's going to happen next. That's usually a hint, right? Like just GTFO, stay out of this stuff. If you have no idea what's going on, why would you mess with it? Sounds easy. It sounds simple. We all get FOMO in different ways. If you can't find your edge, it probably means you don't have any. You should just go ahead and sit out. But as I've been told by more than one person over the years, I didn't learn how to trade just to sit out and not trade. Yeah, I get it. We all want to participate in the market, especially when we've put in, say, 3 hours staring at the charts today and we still haven't gotten day done and we're just trying to get done. I get it. But, don't force the issue. I like my money too much. I don't like giving it away. So, what's more important to you? Just getting the trade on so that you can feel good that you got another trade, or keeping the money you got? maybe not making more today, but you won't make any less. So this was a really simple example, but you should always be able to answer that question. At what point would my trade no longer be valid? That is usually a really good place to look for an exit. What I found with new traders is a lot of times the spot they pick as the place where they think it would no longer be valid is actually the best place to get in, because the new traders are just reading it, say, poorly or incorrectly. So, that's another thing to consider. Where have you been getting out when you're right, when you're wrong? Either way, just looking at where has your exits been happening, and would that place that you got out maybe have been a better place to get in the first place? Say, for an example, if we were trying to short the market off of this high today and you ended up getting in near the low of this run and you have a stop somewhere up here. So it stops you out and then it continues the run and you say, gosh, darn it, dang it. So what happens? It breaks the low of where you had gotten in before. So you try it again and you get in to go short and it runs up against you and it stops you out. And then it runs away without you again. Come on, right? We've all been there. Notice something particular about what I was showing there? Every one of those places where we had gotten stopped out probably would have been a really good place to begin the trade in the first place. Imagine that. I've been dealing with something really frustrating lately, and it's introduction to trading. It sounds really easy. Accomplished traders, we should be able to articulate the introduction to trading really easy. But when I was talking to somebody about this a while back, with what we have at the Bullish Bears, I didn't make the beginning stuff. I didn't make any of the introduction and all of that. I was focused on the advanced level material. And there's a lot of holes missing. And as a critique, they were saying, man, the Bullish Bears, it just doesn't have everything that we need. Well, I mean, to be realistic, guys, nobody does, right? Nobody has everything that a beginner needs because it's a vast, endless chasm of material that needs to be covered. Nobody is even going to have a whole list, let alone the actual material for everything that you need to begin trading. It is impossible. The best that we can do is teach you some of the fundamentals about how to gather resources to get information so that you can start collecting, and then how to build your own lists. Because I had a new trader just the other day say, can't you just give me a list of the things that I need to learn as a new trader? I wish I could, but the list would be as big as a book, right? You think of a book with 700 or 800 pages in it. You could literally make a list of over 800 things that a new trader would have to learn, and you still wouldn't be done. So nobody wants to read a book of lists. You got to get to the point where you're developing your own lists that guide you towards answering those two basic questions. What has been happening in price, and where is price going next? And that's all we're trying to do, all of us as traders, is answer those two questions. So the better you can read price, what has happened, the better you'll understand what has been going on. And then from that, having the education and the background to know what to expect next so that we can make a more informed decision of what should happen so that we can put a trade on. Everything comes back to that. So if you can focus on those two questions, you can grow as a trader, not just from what the BB has to offer, but really a lot of other places. And you shouldn't have to pay an arm, a leg, a kidney to get the stuff, right? There's so much information out there that's free, that or just really cheap, that you don't want to go spending thousands of dollars for these trading classes that I've seen. What a joke, right? Because they're also, no matter how much they charge you, they're not going to have everything that you need. It is impossible. Nobody has it. So you have to learn to piecemeal the information, to put it together from different resources and then contain it somewhere. I always promote Discord. It's they're not paying me anything, right? I have found that to be the most easily accessible tool that everybody can get their hands on. And you've got it on your phone, your tablet, your PC. You can use it on the web. It updates and is in sync on all of those devices. And it holds a lot of different formats. So you can put YouTube videos in there, pictures, upload documents and PDFs. You could type things out, change the fonts, do all kinds of crazy stuff on there. So gather resources, put it into a central database, spend the time to spread it out into categories, build a learning plan, and start working through it. That doesn't sound bad until you start working through it and realize that maybe you don't understand two words in every sentence. And by the end of a paragraph, you've got a whole new list of things you got to go learn. Make room in the Discord, add the things from that list, go get resources, study those things. You will get to the point where it starts to slow down. You won't know it all. I don't know it all. There's so much that I don't know that I don't know. It's kind of scary. But you will get to the point where the education gets to slow down a little bit and that you have a very good idea that when you bring up a chart, you understand all of the things that are on that chart. You have a really good understanding of the price action that happened to get us to that location. You're confident in what you see, and you can make some really good anticipated forecasts of what's going to happen next. If you can do that, if you can forecast price action, now you're ready to trade. Just day trade, options, stocks, futures, it doesn't matter. If you can forecast where we're going next, draw it out, mark the levels, write it down that you think we're going to XYZ for whatever time frame you're on, then now you're ready to take a trade. If you can't, if you can't answer that basic question of where do you think we're going to go next? Where's the stopping point? Where's the next pullback point? Where's the pause going to come in? If you can't visualize it, can't see it, what the heck are you trading? A guess? You can go to Vegas and get free drinks if you want to guess and gamble. So run some exercises where you try to draw it out. You won't get it right. It won't be perfect. But if you draw it like I just drew to the downside and it bounces off a support and it goes to the upside, well, obviously you didn't just get the drawing a little bit wrong. You were just straight up wrong, completely and absolutely wrong. You should be able to not only get the direction right, but the next pause, the next consolidation, and maybe even where we are going to be by the end of the day. So, something to think about, right? It's all just work. You get better at what you work with, and you cannot paper trade your way to success. You can't. So, if you're new to trading and you think, well, I'm just going to get all this software and throw money on the account and I'm going to paper trade until I'm good at it and then I'm going to trade live and make money. No, you won't. This isn't a maybe. You don't hear any hesitation in my voice. There's no wishy-washy, like, well, some people do. You will not. You cannot paper trade your way to success. So if that's what you're trying to do, you can just stop wasting your time, right? And do something else. Getting good at trading comes from education, not from mechanical rote systems of just trying to do the same thing over and over again, like learning to ride a bike. And as soon as you learn to ride a bike and you quit falling over, ta-da, you're done. You know how to ride a bike. When you go to school to be a lawyer or a doctor, they don't just give you a scalpel and say, well, as soon as you learn to cut this, you're good. You're a doctor. Go cut things. So same thing with trading. You got to learn how to read price and answer those two questions. Oh yeah, I love it. Yeah, just do that. Just monkey copy everybody else, right? Monkey see, monkey do. Just do that. Just do that. Yeah, the one thing that I finally came down to is we have to teach people how to learn. And I learned it in college. Well, at least I went through a course in it in college. I didn't actually need it. That was the funny part. When I got into college, they said we're going to have classes on how to learn. And that's the dumbest thing I've ever heard. I didn't pay all this money to go to college so you could teach me how to learn. I already know how to learn. That's how I got here. But when I saw my classmates struggle, I realized a lot of people just don't know how to learn. So you got to learn your way. Some people need to put their hands on it, and some can just watch it, some can read it out of a book. I don't know your way, but you do. And if you don't know, you need to figure out, how do you learn? From there, we need to learn how to gather resources, work through those resources to make an informed decision about what that we're doing, and actually understand the market, not just monkey see, monkey do, because that don't work. There'll always be a new thing, a new indicator, a new pattern, a new setup, somebody else that's loud enough to drown the rest out, to be the one to follow until they blow up, and then there'll be somebody else and somebody else. To be a trader, you just have to be able to absorb information and make an informed decision. And I promise you, you will lose and you'll get it wrong. It happens to all of us. That has no reflection on you as a person, as a trader. It doesn't make you dumb or stupid just because you take a losing trade. I lose every day. It's just a part of trading. It has to happen because we can't predict the future. And every trade has people that are hitting just the buy button. You can't anticipate them hitting a buy button or a sell button. There's no pattern, no signal, no indicator. They just hit buy market or sell market, and price moves. Couldn't see that coming. So you're going to get it wrong. And then you got tweets and crazy news that comes in and rocks the market when you couldn't see it coming. So losses happen. But we can have a really good idea what price is supposed to do. That's where all the patterns and looking back in the past and saying, well, this particular thing generally happens first and then this thing happens next. It doesn't mean guaranteed that it's going to work like that next time, but you kind of get a feel for it. And that's what you want to pick up on. How did price get to where it is now? And what should happen next because of that? When you can answer that question, you're really confident in the trade that you take. And when it starts to unfold the wrong way, you're pretty confident about getting out too. If that confidence isn't there, then you're missing something. So try to figure out what the missing piece is. In the series that I'm going to be bringing out, it's not just trading, unfortunately. If it was, that'd be a lot easier. But there's a lot of missing pieces even before that. I meet people who come into trade and they can barely figure out how to go to YouTube or Google. They don't know anything about software and applications and computer programs. They don't know if they're on a good computer or if they need to upgrade their computer. They don't know anything about digital systems or software or password protection and nothing. Then you got math. You know, math, everybody I've ever spoke to eventually tells me, hey, I'm horrible at math. Maybe you are, maybe you are not. Maybe. Most people don't try. They got their butt handed to them at some point in school when it came to math, whether that was somewhere around multiplication or division. Maybe you got into a little farther along into algebra, and then you stalled out after a couple of bad tests and you said, well, that's it. Well, you need math in trading, at least just knowing how to use the calculator. And that's not me being funny. You have to know what inputs to use to see percentages, for an example, in a calculator. There are so many things what broker to use, how to use the broker, how to put entries in, how to change the order so that it's a different type of order. So try to focus on how to learn and learning better, gathering information, storing it, correlating it, writing notes, keeping track of what you're doing. And if you come across anything that you don't understand, put it in a list and look it up later. Ask one of us. We're always happy to help. There was a mention about AI. When I was thinking about what I wanted to be in life, I had thought about being a lawyer. And one of the lawyer things that I heard was never ask a question in court that you don't already know the answer to. And I thought that was really funny at the time when I heard it. I feel like that when it comes to using AI. I really hate asking AI a question that I don't already know the answer to, because how do I know if it's lying to me or not? So that makes it a little tricky for newer traders. And it's not to say that you can't ask it anyways, but if it gives you an answer that seems a little suspect, a simple Google search should point you in the right direction, or check it against another AI because there's more than one. And when it comes to putting lists together, ask AI some of the topics you should be learning. But there it is a very long list of topics, right? And it's an endless list. So the series isn't done, it's a work in progress, and there's going to be videos with it and everything else. You guys will be able to find it and it'll be organized. The first part of it, though, is just the most complex, I suppose, for new traders because most of them are looking for some concrete answer, and it usually revolves around best. What's the best book? What's the best indicator? What's the best trading strategy? What's the best approach for new traders? And if it was that easy, then there would be a book out there that says this is the best thing that new traders should do. And that's what you should, that's what everybody would use. But there isn't because it doesn't exist. There is no best. There's just what there is, and what might work for you is going to be completely different than what might work for somebody else. We had some talk about brokers in the chat, and when I started trading, almost everybody in the bullish bears was using Thinkorswim at the time. This was before we had micros in the futures, and so futures really wasn't that popular like it is now. The ES didn't have an MES, right? For an example. So Ninja Trader was basically the only thing popular, and it just wasn't a really big thing. So everybody was trading options or trading stock, and they were almost exclusively using Thinkorswim. Webull was not even using options back then, and Robinhood was quickly growing into being the thing. So when I got here and everybody said, "Well, just use Thinkorswim," it's a big program. If you've never used it, there's a lot to it. And if you're outside of the US, maybe you can't even have it. So in the last 5 or 6 years, the bullish bears, we've got a lot more diverse products to trade now. So we got futures traders and stock traders, a little bit of FX markets. So you're seeing a lot more brokers, but being able to answer what's the better broker? The only one who can answer that is you based on what your needs are. There's some simple things like margin requirements. Small accounts really shouldn't be using Thinkorswim or Tasty Trade to trade futures because their margin requirements are just too big. Then there's things like being able to analyze the options with the Analyze tab. Um, I think Robinhood had an update on this. I'm not 100% sure, but as far as I know, you still can't run. detailed options analysis on Robinhood, for an example. So if you wanted to see the risk curve of an iron condor or a butterfly, that broker isn't going to give it to you, right? So the broker has to meet your needs. And then, of course, there's where you live. And if you don't live in the right place, you can't use a particular broker, then you're SOL on that. So, what is the right broker? The one that functions correctly. And that was a part of the chat that we were having today, is that there's issues with a particular broker and it's not functioning correctly. I don't know how to fix it because it's just nothing that I've come across. So, if you can't fix it, you got to find another solution. Although I did have to ask, it said it was a 2-second delay. If it But you don't have that router issue with any other broker, right? So it's not like a device in your home that's causing you issues or anything like that. Oh yeah. Well, see, you went through some of the steps that I was going to mention. You're doing everything right, but I knew you would have anyways, right? It's not like this is the first year you ever messed with a computer before. For others, if it's, and I see this in Discord all the time. So let's just start with something that would be relevant to a lot of you guys. If you're trying to hear the live stream, for an example, and you're like, dang it, my mic ain't working, you guys can't hear me. Before you go changing a bunch of settings, try to log in with your phone. And if you were on your phone, try to log in with your desktop, right? See if you're having the issue on both devices. If it's happening on both, try logging in on the web. Thinkorswim Web is goofy as hell. I gotta admit, it is nothing like the platform that we use here that you're seeing on my screen. Not even remotely close to being the same thing, but they do function differently. And that issue that you're having might not exist on the web version. There was a question about IBKR in the chat, and I had a Canadian client that could not use Thinkorswim. He was stuck with IBKR, options trader, and he's like, "Man, I love all the stuff that you show on Thinkorswim. I like what you're talking about, but when I try to do the things that you do on IBKR, it it just goes to hell or it doesn't work." And of course, I had not used that platform. So trying to tell him how to get to those places to get the thing done, it I didn't have the words because I didn't have the platform. I ended up getting an account at IBKR to figure out how to use it so that I could help my client. And yeah, it was a couple of years ago, so I don't remember all the pieces. I'd have to find my login information and get logged back into it again. But I feel you guys because when I went searching for information on how to use IBKR myself, because I had to figure out how to use it so that I could help my client, the resources out there were not overly awesome, for how to do XYZ with the broker. You had to already have some trading knowledge to know what buttons to push because there wasn't really a lot of videos about setting it up the way you want it, putting the trade on, working the order, and it was tricky. So, yeah, I do think IBKR is pretty awesome, especially when it's pretty much the only other thing you have. You got to use what you got. My answer to that was that I eventually got through to my client's head is, hey, you didn't know how to use it, so I got it and learned how to use it so that I could teach you how to use it. Like the only disconnect there was that I went and learned it first and then taught it to you, and I was able to do it. So there is info out there on running IBKR, and you can find it. And the thing that you're going to want to do is just drill down and keep hitting it until it is something that you can use proficiently. Not just IBKR, right? Like I got Fidelity now, and Fidelity has a desktop app that is just a piece of trash. I never use it. I always just go to the Fidelity website and trade there because I hate their desktop app. But I still learned how to use the darn thing because, at first I was going to give it the old college try and, get her done. Yeah, I ended up using it, but I don't like it. So thankfully, I'm in America. I can just, choose another path. But when you only got one choice, that's all you got. And you just got to keep hitting it. There is no other way to do it except to just do it. And if that means that you stop doing everything else for an entire month, this is the process that I take when I'm starting a project, right? The first thing I do is I start a brand new Discord. So I'm just going to randomly pick one here. I would start a brand new Discord and then I start laying out some channels. So whatever the channels happen to be, I don't know, setting up the user platform or applying charts, indicators to the chart and saving my work, whatever it happens to be. I lay out some channels and then I make one channel for the dumping ground and I go grabbing info, web pages, YouTube videos, blogs, books, anything that I can import into the Discord. I dump it all into one channel. And then when I'm done with my hunt, I start working through those channels or all that material that I found and putting it in the proper channel that it goes to. If I didn't make a channel before, I'll make one as needed for whatever I found, and then I'll work through the information that I found. I've spent entire weekends doing nothing more than grabbing information from the web. Some of it was good, some of it eventually maybe wasn't good and I had to throw it out, but you don't know till you have it, right? So when it comes to IBKR, you're going to want, for an example, the user manual. If they have a YouTube page, which they do, you're going to want to have their specific YouTube page, not just Joe Schmo in his grandma's basement. If there's anybody popular who works there that has their own Twitter handle or their own YouTube page, you're going to want to get those connections so that because they're going to share resources and videos and things like that. And if they work for the company, not to say that that they might have an odd duck that isn't very good, but for the most part, if they work for the company, they probably are putting out good stuff. And just gather up everything that you can get your hands on to help you better understand whatever product it is. Now, I've done that for trading books. I find a good trading book that I like, and I will open a Discord just for that book, and I'll rip that book apart one chapter at a time and put it into a Discord, taking notes, seeking out more information on the web that correlates with whatever book it was that I happen to have dug out. And the reason I was doing that is sometimes these trading books can just be a little dry or a little complex, and we need some depth behind it, or it's hard to remember everything that we read in the book. So when I could take a book like this Discord here is The Art and Science of Technical Analysis by um, Adam Grimes. I took this entire book apart chapter by chapter and loaded it into this Discord. And then from there, I was, working through the chapters. I'd read a section, and if it had something of interest to me that I wanted more information on, then I would highlight that in another channel and go searching on information about it, right? Just really getting the most out of my time and effort and moving it around in my brain from just something that I happen to have read that I might forget about 20 minutes later into something that I interacted with. I studied it, I hunted for it, I read more information on it. And that to me helped me remember the stuff that I was working on and to learn more about things more diverse than just this is a moving average and that moving average needs to go above that moving average, right? A little more complex, a little more in depth. There is 70 years of really great trading information out there. I know that sounds vast, but it's really good stuff. And honestly, if you're dealing with options, you don't need the 70 years because it's all outdated past, say, 10 years. You can really just keep anything focused on options in 5 years or less. Don't go back any farther than, say, 2019 ish. You can, but you don't need to. So that'll save you a lot of work there. But price action is price action, and it hasn't changed since before people were even using charts. That was really cool when I found out that I can't remember the name of the group, and I would give attribution if I could. But there was a company that went back and looked at the written trade records from like, oh, the trading company that used to be in Europe that helped when they were trying to settle the Americas, and then when we had the war with Europe and we gained our independence, and right there was this company that was involved in things back then, and there was trading going on. And sure, they didn't use candle charts, they didn't even use line charts, right? They were just keeping tabs of everything in these written ledgers. But if you went back and you marked out the buy orders and the sell orders and the highs and the lows and when prices would change and fluctuate, sure enough, if you mapped it out, it looked a lot like our line charts. We didn't have, the open and the close, just the high and the low, or I should say the close to close is pretty much what they had at the time. But that's a line chart. And it showed head and shoulders and wedges and squeezes. That is really cool, right? Like the same stuff works. It's not because we can see it, it's not because of more traders interacting with it. Heads and shoulders don't function for any other reason than just that's just what price does, right? Which is cool, and it helps answer the question of the chicken and the egg. Did the price pattern work because people saw it, or did the price pattern work because that's just what the pattern does, and it wouldn't matter if we interact with it or not? At least it solved the question for me because I always wanted to know that answer. I will tell you though, if the pattern is pretty, it works better. Maybe that's because if it's pretty, it formed correctly, and that if it isn't pretty, it didn't form correctly. Maybe that's the reason. I don't know, but a quote textbook pattern has a near flawless follow through, whereas the uglier the pattern, the less likely it follows through. Just saying. So for the problem with the broker or problem with software or apps or whatever it is that you're struggling with, the steps that were just laid out to you, because I think Marziti did a good job of, he hit everything I was going to say. Try it on different devices, try it on somebody else's internet, reach out to support. You know what I mean? Like, he already did all the steps, but that's what you would want to do as well. Try different devices, reach out to support, try a different internet. That way, you don't change the settings on your PC or whatever device it is and end up, you know, getting it out of whack. I saw someone delete their password or change their password, but without saving the new password. And they just created this entire mess, all because of a password issue. And they end up deleting accounts. It was an ungodly mess. And the passwords weren't syncing on the different devices because, nowadays we have password managers and auto logins. And so just try to work through the basics first. Um, on this internet issue that we were talking about, it really sounds like a day trade trouble issue only, right? Your swing trades shouldn't have any problems. Well, yeah, I don't want to use anything I can't trust. You don't use one now? I started using VPNs when I was digging deeper into world news, because I didn't realize how isolated Americans are from the rest of the world when it comes to information. We are. And I felt really ignorant when I finally got on the world stage and saw world news that had not been spoon fed to me by the American system. What a shock to see how the rest of the world actually sees us and talks about us. I was humbled, and it was eye opening. Yeah. A little bit of an echo chamber. If all you ever hear is material that is generated by us for us, then you're never hearing the opposition at all. And in my case, I didn't even realize that there was opposition or that there was just an alternative point of view, because you think they're giving you the other side here. You think they're telling us what others had to say, but even that, they're only telling you what others had to say if it fits their agenda for what they're trying to spoon feed you. So if you don't use a VPN, give it a shot sometime, guys, and take a look around the world at news. What's going on out there? The price patterns. I didn't get too far into this on my material that I'm working on at the moment, but price patterns are kind of the foundation for what's happened in the past and how we have an expectation of what should happen in the future or what should happen next. So that's where we get the confidence to say, that's a really good low, or we're overextended at the high. is because there's these repeating signals or patterns that we can say, oh, yeah, a lot of times when this happens, this is what happens next. One of my favorites is a morning star reversal or an evening star reversal, preferably on a daily or a weekly. And if I can get a gap involved, that's even better. A weekly gap up with a morning star reversal on a weekly chart is a very beautiful trade. Nice reversal. And if you're thinking, I don't know that one or I don't have a favorite, it's something to focus on, to take a little extra time and maybe shop around the different patterns that are out there and just like window shop, look at them, flip through a list on the internet, or if you got a book of candle patterns, do that. But flip through the list and just see which one catches your eye. Start there. I say that because we don't all see patterns the same way. When I was new, I could not see head and shoulders. I couldn't see it as it was happening, but I couldn't even see it in the past. Looking back on a chart, trying to find it somewhere else, I just couldn't see them. And I thought, well, it's because I was new. I was trying to be generous. And then somebody else joined the bullish bears, newer than me at the time, and they were like, "Whoa, hey, did you see that head and shoulders?" No. And how the hell did you see it? You're freaking new. You're not supposed to see it. And it started to dawn on me, that we all see patterns differently. So when you're flipping through the candle book and you see something that really speaks to you, hone in on that because you're already seeing it. If you're seeing it in the chart and you see it often, hone in on it, learn more about it because it's a pattern that you are already identifying with. Eventually, I did learn to see head and shoulders. Eventually, I got there, but it was only after doing a lot of work to get to that point. So focus on the ones that you are seeing without you're just seeing them all natural, right? You didn't even have to put any extra effort into it. And the patterns can be your trade signal or they can just be a part of your analysis. A lot of times the signals that I see don't trigger a trade for me. They just provide insight so that I can have a more thorough analysis. Like the Busby, I made that one up. So, usually when the term Busby comes around, it's connected to me in some way. I didn't make Price start doing that pattern, right? It was already doing it on its own. I just gave it a name, basically because I got tired of saying the same sentence all the time. When price is in a range and it finally breaks out of that range, very often it will come back and validate old resistance as new support. That's it. But if you say that sentence 50 times today, you're going to get tired of saying it. It'd be a lot easier if you could just give it a name. And so I named it the Busby. And I did a couple videos on it, and everybody said, "Oh, that's a great trade strategy. I love it." And now I get questions about it all the time, and people are always asking me how to trade it, how to trade it, how to trade it. The funny thing is, I rarely ever trade it. I use it for analysis because if we get a Busby, we're very likely starting a trend. And that's really valid because if we're starting a trend, I can start looking for trend trades and, get in and get out and make some money. But the Busby itself isn't the trigger for my trade. It just helps define the analysis for that trade. So all of these candle patterns, they sound like a lot because there is a lot of patterns out there. You don't have to trade them. You can slowly learn them a little at a time and use them for the background of your analysis. Like a head and shoulders. That's a reversal pattern most of the time. And the inverse is a bullish pattern, a reversal off the lows, while a real head and shoulders is a reversal pattern, bearish off the highs. So if you find a real head and shoulders and it's at the bottom of the range, you don't want it. If you find an inverse head and shoulders at the top of the range, you don't want it. It doesn't belong there, right? being able to apply that analysis to the candle chart to be able to say, oh, wow, yeah, that's a head and shoulders. That's a bearish signal. And then you look at the ticks and you see more bearish signals and you realize they're, buying options like crazy. So there's another bearish signal, right? And you just start seeing more and more and more bearish signals. You kind of get to the point where, like, I think this thing is bearish. Got all these signals telling me to go short. And you find a short entry somewhere. I know indicators are popular. Um, at one point, I used to know how many indicators were on Thinkorswim when you got it new. I don't remember now. Let's just say there's um, 600 indicators. So you turn on this program, it's got 600 indicators. Which one's the right one? Which one's the best one? What's the better one for newer traders? Which one's easier for newer traders? No such thing. Doesn't exist. And there was an interesting book. I think it was in the Art and Science of Technical Analysis, but if it wasn't, then it was in the Gerald Appel book about analysis. It was in one of those two. Good luck. I hope you get it done before it rains. Have a good weekend and don't get a heat stroke. I see kidney stones in your future. So you got all these indicators, and there was a technician. It was either Adam Grimes or Gerald Appel who said you could pick any indicator in here, right? You could just run like an algorithm that randomly spawned one for you, and whatever one it happened to have picked, if you spent the rest of your life learning how to use that one indicator better and better and better, that you would be a professional trader, profitable, consistently profitable trader, and could, go through your life and retire on your foundations, the money that you've made. And it didn't matter which one it was, because there is no best one, better one, right one. There's just these tools, right? Now, I'm not an indicator trader, so that doesn't really apply to me anyways. But when I'm trying to do analysis, there's no best indicator for analysis either. But I thought it was interesting, and they had a lot of detail behind it. Like I don't quite know what the CSI is, but let's apply that anyways. Okay, yeah, we can work with that. So they say you get this indicator, you don't know anything about it, you throw it on the chart, and now you got to start learning how to use it. Well, one of the first things that we do is we try to match that indicator with price action. And so even new traders who don't know about anything yet, while they're trying to learn how to use that indicator, are inadvertently also learning how to read price action, because they correlate the two, right? And try to match what's happening in the indicator with what's happening in price action. Now, me, I just skipped the beat and went right after price action, and I didn't really fight the indicators too much. But some people don't make that transition until late in their career or ever. I know traders who's been doing this for 40 years and they still use indicators. So, hey, you know, use what you like. But there's no solution of the best one or the right one or the better one. There's just, these are the tools we have. What is it that you're trying to analyze? Or what are you trying to find? That's where indicators can get really cool. Because if I want to study price action and look for momentum, there are momentum studies. You can load one of those and look to see, do we even have momentum? And if we do, is it increasing and getting stronger, or is it decreasing and getting weaker? I mean, that's a really good thing to know, right? I can see momentum in the candles, but I can't tell you the exact momentum that we're moving. Kind of like sitting in the car. I can tell you that we're going fast, I can't tell you how fast until I see the speedometer. We're doing 55 and a 30. Yeah, that's fast. But how fast comes from having some kind of tool or a gauge, right? 55 seems fast until you realize that we're doing 55 and a 75. Well, now it's not so fast, right? So you got to have context, and that's where indicators come in. I don't use them to trade. That's just me. But from an analysis standpoint, they really are helpful because they allow you to put a number to it. That is a nice TRB setting up. Let's bring that into the live stream here for people watching the replay. So we were talking about a TRB pattern, and this is a good example just shared in the chat. Now, I like this little pattern. Hey, what's with my, there it is. This is like a 3-bar reversal here, and it's also a morning star reversal. And if there was a gap in that, oh, that would have been perfect. But it's an intraday chart, and you'll rarely get a morning star reversal with a gap on something like the indexes. You can get it on equities more. Like if this was Apple or Netflix, we could have had probably a gap. But with the futures, very rare, right? But really nice reversal. And then when you bring it out and you look, in a bigger picture, getting away from those 3 bars, there's your target parameter, right? Back into the 42 channel. So looking at this, we've got to get through the 50 because this is the NASDAQ. We got to use quarters instead of cog lines. So you got the 42 channel down here, which was the entry point. Then you got the quarter, 75, the roundy, up into the next channel top, 42 to 42. Love the NASDAQ. The cool thing about the TRB is it can eventually form a cup and handle, which is cool. One thing to be concerned of with a TRB is stalling in the middle, right? That can be troublesome. So if we come down and we run up and we get stuck on the midpoint and then we continue to the downside, that is always a concern, right? So we have to be mindful of that. But that's good. This is a swing low pattern. And after a swing low, getting those wicks on the bottom of the candle will allow other traders to get in if you're not in yet. Just like here, we had a swing high and we started going down. And after a swing high, we get these wicks. Those wicks offer you a chance to get in, right? You wait for the current candle to close, perhaps, and then when the new candle opens, you don't immediately try to hop in and go short because you already know, hey, Joe, there's supposed to be a wick, right? So, yeah, Bob, yeah, a wick. Let the new candle open, wait for the wick, then get in. Even if you don't get in on the wick, because, price moves fast and maybe we just don't catch the wick. At the very minimum, once candle closes, the new candle opens. Oh, that's hard to read. That's better. New candle opens. You get the wick. You can let the wick form and let price come back through its own open and then trigger, right? It doesn't have to be you getting in somewhere on the wick, but just be mindful of, hey, there's supposed to be a wick because that was a swing high and now we're headed down. This was a swing low and now we're headed up and there should be a wick. This one actually wicked on the mid. I like wick in the mid. So midpoint of that bar, I didn't quite catch that with my drawing, but the middle of that bar would be where we expect that wick to bounce. And so if you're trying to trade this and this bar closes, the new bar opens, and we're trying to see if we can get hold candle at high of low day. Of course, we're not using a daily chart, but day would just be replaced by bar. Cahold. What? Cahold. Once it breaks through that, there's your trigger for identifying long opportunities. Anywhere in that green bar could be your entry, but if you don't want it because you want to see if it gets through that bar, it does. It closes above. Now you're valid to go long. What happens? The new bar opens and you say, I got a swing low here. New bar opened. There will be a wick. I wonder where that wick is going to be. If I'm lucky, I might get an entry off that midpoint. And you can just reach down there and set your order right on the middle of that candle. Worst that's going to happen is that you don't get filled at all, that it just opens and with no wick, it continues to go up. Well, shoot, you didn't get filled on the middle of that bar. You can catch it as it breaks out of the green bar and go long from there. But you could have at least tried. If you had done that this time, you might have bottom wicked. I miss a lot of trades trying to bottom wick like this. So, if you're more interested than getting filled, don't do this technique because you are very likely not going to get filled and then you'll miss your trade and then you'll be upset. But if you miss the wick, say you wasn't fast and the wick formed and it missed you and it's running up, you can wait for it to pass its own open to get in. And if you don't like that entry, you can let it pass through the last bar's high to get in. So multiple triggers to actually get the trade on, right? And then where does your stop go? Always got to have a discussion about the stop. The books will tell you to put it here. I would say at the, you know, as low as you can get while still having some structure. So below that last bar is low because we are talking about getting in on this bar. The low of this bar would be good. Below the open of that bar would be good. Or if I didn't get in on that wick and it missed me for whatever reason, I wasn't fast enough, or whatever, we didn't get the wick, then you can set your stop under that wick's low. You know what I mean? Like, why go all the way down here if you can use that for your stop? Once we pass through this close, you can move your stop up to the difference of the middle of those two. And once we break out of that bar completely, you can move your stop up to the close of that bar, right? Just keep using structure to stay consistent. Hide behind this low, then hide behind that close. Then once we're out of this completely, you can hide somewhere in that wick zone. Just keep moving your stop up while staying hidden behind something. The same tactics work for swing trades, especially if you want to do like 0 day play, not 0 days, but short plays. If we want to like do credit spreads or something like that, and we think it might stall out, same tactics work. CSI Miami, what is this thing, anyways? The Commodity Selection Index, product of the Average Directional Movement Index, the ADR, the ADXR. It's very interesting, but it does seem to be particularly focused on commodities. Kind of like how VWAP was not designed for equities, right? And then we all stole it and used it on equities anyways. It says it's suitable for short-term trading, which is what got my attention. You know how rare it is to find an indicator that says it's suitable for short-term trading? That's rare. That's why I like, oh, really? So I don't know. I think I might dig a little deeper into this. At the end of the day, I still don't use indicators to trade, but if this is designed to help you better analyze short-term price action, I think that can be helpful. CSI. I do like the 3 bar. Have you gotten into drop base rally, rally base drop type stuff? For those watching the replay, this DBR that I drew by hand looks a lot like this DBR right there. Mine, my green bar did not exceed the red bar's um, high, but still, I hand drew this, right? This was just me making a candle pattern to sticker. But drop base rally, DBR. It can be rally base rally, rally base drop base drop, and drop base rally. Well, that's a lot to string out there, but the question about how to determine targets, there's no uh, there's no correct answer for this, but there's a lot of ways to approach it. Some people will say, if I risked whatever distance this is, let's just say it's 10 points. If I risked 10 points here, then my target has to be 20, for an example, right? Twice whatever I risked. And that's okay for like an off the cuff scenario, just so that you can look upwards and say, hey, can I hit 20 points without getting stalled against some previous level? And if not, maybe I need to reduce my risk so that I can keep my ratio 2 to 1, 3 to 1, 5 to 1, whatever. If you, this is a really big range, so we don't really have that problem. But if we were looking at the range that we had talked about before, then the one that I was showing at the beginning of the stream today, then we would really have to answer that question. And in fact, I was having this conversation with somebody um, yesterday. So if this is my range, it looks like a lot, right? But it's only 10 points. If I'm using a 4 point stop and I've got a 10 point range, can I take this trade? Now, everybody has to answer that for themselves, but here's a little bit of market logic. You are not good enough to get in at the low and get out at the high. And by you, I don't just mean you, I mean like me, you, Joe Schmo, Bobby Jr., you're not going to consistently hit the absolute low and the absolute high. So if I have a 10 point range, you should not expect to get all 10 points. And if you're going to risk 4 for some of 10, well, how much of that 10 do you theoretically, realistically think you're going to get? 25%? All right. Half is 5. So half of 5 is 2.5. You can't risk 4 points to make 2.5 points. This trade could not happen for me because my rules say I can't risk 4 to make 2. I have no trade here. Well, that sucks, right? Nobody wants to hear, sorry, can't trade. But there's not enough room there to take a trade with the stop that I'm using. I either have to adjust my stop or adjust my target. How? When that's the high of the range. At the time, it was the high of the day. It was like the highest high of the year, of the forever. We've never been that high before. So couldn't expect that we were going to go higher. Take this reversal here. This is completely different because we've got all of this. We're talking about getting in, from 85 to, let's just use 35 for some simple math. That's a 50 point range. Now I've got a lot more room to work. Theoretically, what's the target to the upside? We want to start laying out, what could I hit? I don't have VWAP turned on yet, but We would have to worry about VWAP. We would need to worry about any of the big major moving averages like a 200 period or a 50 period. If there was any dailies, which there's not, but if there were any dailies that we were going to hit, we would want those on here. And then there's where did we open? Because that one is going to get in the way if we keep going up. Where was the 5 minute open range low? Because if we're going to hit that, we want to know because that's the 5 minute open range. Any big options level like 6,200, we want to mark that one. The 92 cog line, which is basically where we stalled out in this bar. So the targets are what is next? What are we going to hit? When we get there, we can start to lighten our load a little bit. That's why we want to feather our way in and then feather our way back out. So say you get in, and as you're moving towards this target, you build your position out to 6 contracts. And then when you get near that area, you realize, hey, we're coming into some areas where there could potentially be resistance. And you would begin to reduce your position size from 5 to 3 or, from 3 to 1. You can still stay in. You just want to reduce your risk because what happens if we reject there and we go down? You at least took most of the profit off and you can leave one on for a runner. And you would, depending on your trading style, keep trying to run it until you run it all the way back up. But as I've mentioned before, I don't run that style anymore. I outgrew it. I don't want to be in a trade from way up here to way down here. I mean, I know that's what everybody talks about, but I don't want it. Give me the money, sure. I mean, hey, you offer, uh, yes, please, I'll take it. But I don't want to sit in a trade for 3.5 hours fighting all of these pullbacks and all of these levels and not being able to go do anything else. I like my freedom. I would rather get in and get out and then get back in and get out and then get back in and get out. I'll take that all day long as there's still a solid trend with momentum behind it and a new signal opportunity to participate in the trade. So we had the reversal. We begin our move up. We want to lay out clear areas of resistance just by looking left and asking, what are we going to hit? And then as we get into those zones, be prepared to reduce position size, not necessarily exit, right? And if you are the trader that wants to hold in all the way back to the top, then as long as it doesn't violate your entry, do that. Just keep moving your stop up. But trading exits are very personal, kind of like wearing a pair of shoes. Some people tie their shoes every single time they put them on. I'm not that way, right? Some people don't even have laces, they just wear slip ons. So when it comes to tying your shoes, what's the right answer? Are you supposed to tie them or not tie them? Do you tie them tight, or you just kind of make them look like they're tight? Same thing with trades. What's the exit? There are people who only want what they risked and they're out, like a 1 for 1. Some want 2 to 1, some want to stay in the damn thing as long as it's continuing to move in the direction they took. I mean, I don't like that, but you do you. There's some no-nos, I suppose, right? What I don't want to get out with less than what I risked. I will if I think the whole thing is beginning to unravel, or if we're getting too late in the day, I will get out. Profit target be damned, right? I'd rather avoid the risk and get out rather than holding it into, say, the MOC at 350 in the afternoon and then getting a pop that goes against me. Risk to reward is directly connected to your win rate. I know that might seem counterintuitive, but the better your risk to reward is, the higher your loss rate is. To say it another way, you will lose more often if you have a really good risk to reward. Doesn't that suck? I think it sucks. I have a really good risk to reward. I try for 5 to 1 and I hit 12 to 16 to 1, right? That's my average or my norm. I'm not trying to go for 16 to 1. That's just what I get. What I'm trying to get is 5 to 1, but I have a loss rate more than 30%. And most new traders that I talk to are like, damn, you lose 30% of the time. You suck. Okay, I suck, right? I pay the bills and put food on the table, but whatever. I still lose 30% of the time because I don't compromise on my risk to reward ratio. At least I try not to. So if you want to win more often, use a lower risk to reward. That will bite you eventually, but it helps new traders, which is why a lot of times new traders will go for a 1 to 1. If you risk a dollar, you try to make a dollar and you jump right back out. You just get out there because going for a 1 to 1 helps you keep your win rate up. But that means you have to win at least 55% of the time so that you can maintain your balance and pay your commissions off for the trade. So if you can win, say, 60% of the time and you can make a 1 to 1, you can keep your account alive and continue to grow the account. Anything above a 60% win rate with a 1 to 1, you're growing your account. That was a really nice 3 bar. I like it. The drop based rally was really insightful when I first started getting into it because they really focused on the quality of the leg out. So let me see if I have. I know I built something on this. And the drop based rally works for any type of trade too. So day trade, swing trade, daily, weekly, doesn't matter. I put together some stuff on drop based rally. Drop based rally. So what really got me interested in this one was the leg out because you can have things like a Marbozu for the leg out or um, a long-tailed doji or something like that. So say like supply and demand zones, that became really popular for a while. Everybody was all over it. And it was really just another way of articulating a swing low, a swing high, drop base rally, 3 bar reversal. It has so many names, so many ways to look at it. But when I started to mark out the zones, one of the things that I really focused on whether or not I was going to market at all was whether or not it had a really good leg out. So I've got some pictures of really amazing legs out that I think kind of exemplify the the best kind of swing low, swing high, or drop base rally, and they are the ones that I end up marking most often. Like one of these where it's got that really nice wick extension, or here where it's got that really nice leg out. That reversal is really good, but this leg out, that red bar down, how it exceeds everything and it's just such a really big drop. If I go to mark zones, I wouldn't be marking this one or, any of these, that up there. I would be focused on that right there as a spot to put my pivot, because this is a textbook rally based drop where I can put my proximal line in, my distal line in. This becomes my zone, and it's where I expect to see price come back for an opportunity to trade. So I got a run up that I can trade, and I got a run down that I can trade afterwards. It helps because I'm no longer focused on marking every single turning point and trying to mark all of these overlapping supply and demand zones, that I'm focused on very specific ones that have, the right middle bar and or the right leg out. Well, the leg out can be a leg up, right? We flip the whole pattern over, run it the other direction. So, and that was another one. Really nice leg down on both of them. Or that's the one that we had just talked about. So the drop base Raleigh has a lot to offer, especially for like newer traders trying to figure out what to mark, where to mark it, what to expect out of price after we do market. And then if you're bringing in multiple time frame analysis, I drew these, and I got to say at the time it felt really funny drawing these candles, right? But this is the drop base rally. You would not see this in real life, right? We see those three bars that we were just talking about with the doji in the middle and then the big leg out. But if we took that 5 minute picture with the three bars and we opened it up into a smaller time frame, it might look a bit like this, right? Where you have the drop base rally. So, focusing on leg bars or belly bars, base bars, two-bar reversals, three-bar reversals, Pinocchio bars. And then, of course, you start adding in liquidity, actually watching actually watching the tape. That helps. Some of my favorites: Doji, Harami, Hammer, Hanging Man, Morning Star, Evening Star. And of course, you got Ignition, Marbozu, Belt Hold. I don't know if you guys really get into proximal lines and distal lines, but something to think about, right? If you're looking for consistent ways to mark out your zones, the proximal line, generally everybody uses the same one, but the distal line can be swapped, or say that the other way around. The distal line gets the same spot every time, but you adjust your proximal line. I like to do it that way. Distal always goes to the lowest point, and then the proximal can be either the highest point of the base, the lowest point of the base, which has the greatest success out of the three, but the lowest frequency out of the three, or off of the highest candle body in the base. That's your second most successful and the most commonly used out of the three. What you got there? Oh, ice. Thank you. So do you guys always use the distal line in the same spot, or are you changing your distal line? And do you place your proximals in the same spot every time, or do you change it up? I try to do it the same way consistently all the time and not change it up, but to each their own. Thank you, baby. And I don't see curve talk here much in the chat, but it's really another form of multiple time frame analysis and where on the curve your zone was developed, right? Like supply and demand zones, which I never talk about supply and demand zones. But when you are marking out, you know, key areas, does the freshness of the area change your approach on what you expect to get out of that area? Let's see, we got a question in the questions channel. What is the difference between a liquidity sweep and a break of structure? Um, they're not the same thing, so that's a good thing. Start with the idea that a liquidity sweep is an action to gather liquidity, right? I mean, the name tells you the action. So if you've got a zone or a range, I usually say this is something like a um, raid draw. The draw would be drawing everybody into the range. And then once we are in that range, they will raid liquidity on one side and then run it the other direction. You can call that a liquidity sweep if you want to, right? Like they swept liquidity down here. But a break of structure would be something completely different because in that situation, you are defining a particular area. Maybe it's that range that we were just looking at. And then you had price break that structure. Maybe they do a liquidity grab first. Maybe. So they grab liquidity and then they break structure. Maybe not. But gathering liquidity up would be doing one thing, breaking structure would be another thing. I understand why you could have some confusion between the two because if you had a price in a range and then you broke that range, well, you broke structure. But if you only broke it to gather liquidity before you ran the other way, then that was your liquidity street sweep, and this was your break of structure. So it's a bit nuanced. At the end of the day, you really want to try to define why is price doing what it's doing and what should I expect it to do next. So once you have identified that there is structure, once we leave that structure, whether it's a range or a pattern like a wedge or whatever the structure happens to be, once we leave it, you want to try to answer why did we leave? Are they gathering liquidity to go in the other direction? Or is this the true break and we're breaking and now we're going? Oftentimes, you can try to define that with cumulative delta, tape speed, movements on other products like the VIX or treasuries, gold, commodities, dollar, whatever, right? Looking around, asking, why are we moving? Options flow, something. It's a good question, though. So I consider myself a pivot point trader. And at first blush, that sounds pretty easy, right? Like we can just load pivots. So we got SVE. That sounds complicated, but that's your basic floor pivot. And when I turn that on, what we will see is the purple line, which is the actual pivot, and then the SNR lines, which I happen to talk about in the morning briefings. So all of these are pivots, and we're at R2, which is where we finally rejected before we fell, and we almost made it back to the floor pivot. But we did make it to R2. I was surprised because when we got stuck at R1, I really thought that was going to be it. But nope, we made it through R1, we got to R2, and that was it. How many of you spotted this when we got there, by the way? Because when we reverse, it's not like you want all of these pivots on your chart all the time, right? But once we reverse, you can cycle through the charts and say, hey, what did we hit? Was there anything up there? R1, R2, ADR. Did that happen to be up there anywhere? So there's a pivot. But then we've got other pivots like daily close or yesterday's high, yesterday's low. So now we've got even more pivots. Those yellow lines are the high and low of the previous day. There's the close. Now we've got the close, the high, and the low. It'll be this orange bar. It's kind of buried underneath another line, but it's in there. And of course, that isn't all the pivots because there's a weekly pivot. There's a pivot channel. Today's open is another pivot. The Globex high is another one. The Globex low is another one. And it just keeps going, right? And then you got yesterday's Globex high and yesterday's Globex low and the weekly Globex high, the weekly low, not Globex high, weekly low. Just on and on, right? More and more and more pivots. If I keep adding them up, we would have so many lines you wouldn't even be able to see price. Well, how fresh are they? Yesterday's high and low isn't as good, perhaps, as Globex high and Globex low, because, which ones are freshest on the curve? Whether or not we hit them today is another one. If we hit the Globex high 3 or 4 times, but we haven't hit, say, the RTH low of yesterday, well, maybe we wore out one, but we haven't even hit the other one yet. When we first get there, it might be more solid than the one that we've been pounding on for the last hour and cutting through in and out. The funny thing is about pivots is you end up playing them eventually a lot of times the same way. The 3 bar reversal, TBR, Morning Star, Evening Star, Doji, Haramni, Hammer, Hanging Man, because it's just the same reversal. It just happens to be off of a particular line or level. So I like pivot point trading because it's really universal. I can use it on all time frames and I can use it in all styles of trading: stock, options, futures, forex. It doesn't matter. I can use it on everything. And you can add to pivot point trading. You can bring indicators into it if you want to. Momentum, trend, inertia, VWAP, moving averages, MACD, stochastics, all of them play into pivot point trading if you want to. That was a nice reversal, I got to say, off of the lows, and a really good pattern. If we go up here and look at some of these reversals, this wasn't very good. You know what I mean? Compare this trash. We'll just back up to this point right there. If that was what we had for the reversal today, that is not a very good reversal pattern. And sure, it was the reversal, right? But it wasn't very good compared to what we got at the low here on this reversal here. This was a really good reversal. I had a question about a comment I had made the other day when I said I just get in and get mine and then get back out again. Somebody asked me if I was a scalper, and I do not consider myself a scalper, but it sure sounds like that in the phrase, right? I want to get in, get mine, and get right back out. I don't want to sit in this thing for half a day. And so that, it was a fair question. Hey, are you a scalper? Compared to Jeremy on a 10-second chart, I am in no way a scalper. But I haven't changed my strategy since before COVID to after COVID. But my time in trade has dropped by a good 60%. So if we put that on a minute by minute basis, instead of being in the trade, for 60 seconds, I'm in the trade like 20 seconds. Only instead of being in the trade for an hour, I'm in the trade for like 20 minutes, right? On the ES, my average trade is 8 to 12 points. It used to take an hour and a half to get 8 to 12 points because that's how the ES moved. Our entire trading range was less than 40 points a day on average. Think about that. The NASDAQ on average was making 70 points a day, 70 to 90 points a day. For the entire 24-hour trading cycle, from where we closed yesterday to where we closed today, oftentimes the entire move of the day was nothing more than 70 or 90 points. So when I was trying to get 25 out of 75, it took an hour and a half, 2 hours. I was in the trade a long time. Now you can get 25 points in the NASDAQ in 15 seconds or less, right? I mean, if you do it at the open, you can do it in the blink of an eye. But, later in the day, not at the first 30 minutes of the day, you can get 25 points pretty fast. So I didn't change. The market changed. I still don't consider myself a scalper, but I'm in and out in a much shorter period of time. Hey, we made it up to the next channel, 42 to 42. It's the top of the green box to the top of the green box, 100-point range. Yeah, buddy. What a run. I agree with you. That was really nice and really clean, too, all things considered. Did the NASDAQ have that good of a reversal? Yeah, really nice. I would argue that the NASDAQ had a better reversal. And they're almost the same, huh? Yep. So watch that VWAP. We are back to the VWAP. We rejected on the 32 part of the channel. We may not even get into the top part of it now because of that rejection, but it's still trying. So let's take a look around the broader market and look at a couple of things. Um, by the way, treasuries are now moving with us. Earlier today, we were disconnected from treasuries. And it looks like we got the options market with us too. So we got everything doing the same thing. Take it while you can get it. Looking at the Mag 7 complex, they're still good. We do have divergence. If we look at the stochastics, we're getting lower highs and lower lows. But if we look at price action, we're breaking these ranges higher and we're getting higher highs, higher lows. So we do have divergence there. But Mag 7 still strong. You can't short the broader market with a strong Mag 7. Looking at the advancing versus the declining issues using the W series, which is basically a picture of the Mag 7 again. This is pointing at new highs on the month. It's higher highs, higher lows. Can't short the market if you can't short the Mag 7. This says don't short the Mag 7. So I know we're at all-time highs and everybody's like, oh, we're at the highs. What do we do? Um, I'm not saying buy the highs, but don't short the market. Not right now. Have a lotto. I got a lotto, right? I got some NASDAQ puts, the QQQs, right? We put some puts on earlier in the week. I got some, but they're really cheap, low risk. And if it doesn't work, whatever, right? I'm not going to get hurt. Don't load up big on a big fat short because from what we can tell so far, we got no short coming. This is US 30 JP30. It really mimics the indexes. So when this is bullish and long, the indexes are bullish and long. If there's no short here, there's no short in the indexes. So that's three different signals so far that's all saying the Mag 7 is strong and that you shouldn't short the market. This is the 10-2 curve, and there's other curves. There's no magic in this one, right? The Powell a couple of years ago gave us like 7 different yield curves so we could all look at. But at the end of the day, we got what they call a flattener, and as long as this is flat, then we got nothing. And not only is it flat, but it's pointed upward. So we're not going to get some drop into a negative yield curve or anything like that. We're still growing the curve to the upside, and there's no resistance coming until at least 57, 0.57%. We're good. This is saying don't short this market, right? At least not now. This is the VIX 3-month versus the VIX 1-month. So when it's pointed to the upside, we are in contango. That means we're in normal volatility, and that's where we're at. We wouldn't want to short the market unless or until we get a crossover that points to the downside, and we don't have that. So we don't have a short in the market, and we're not in backwardation unless we get below the 1.0 line. We're definitely not in backwardation. So another broader market signal that says don't short this market. This is kind of a big picture point of view. It's a monthly chart, which means every candle is 1 month. You do not use this for timing a trade. You know what I mean? Like this doesn't tell you to get in or get out, anything like that. But in the big picture, when it comes to technology and the Mag 7 and the hyperscalers, we've had 3 solid months. And this is a Morningstar reversal with a gap up on a monthly, no less. We were just talking about a gap up on a weekly and how powerful it is, how awesome it is. It's such a great signal. It's 4 times as powerful on a monthly. Don't short this market. This candle is at the high of the range and it's a monthly bar. So we're talking about June's candle is going to close near the top, at least so far. Next week, right? Monday, Tuesday, we could fall back down and leave a wick behind before we close into July. But we don't have that right now. Don't short this market when this thing's pressing into the high of the bar of the month. We do have some resistance coming. We can see that 3.30 and 3.31, the last 3 times that we got up there, we got rejected. It's absolutely possible that we get rejected again, and that would be the start of a good short, a short-term short, right? We're not talking about long-term kicking the can to the S&P, 2800 area. But if I'm looking for a short in the Qs or in the S&P, in Apple, the Mag 7 group, then I want to see this rejection and this begin to roll over and start going to the downside. Give me half of this green bar or break out of the bottom of that green bar with the July bar, and I might consider some shorting opportunities. But if we get that, we would have this also pointing down, and we would have this pointing down, and this would break 2.13, and this would break this trend line and be back into the downside. You know what I mean? It'd be all of these things adding up, telling us that a short would be a good thing to do, and we don't have any of that. This is RSP versus SPY. It's a old school classic ratio chart. It's basically the weighted versus the unweighted S&P. When it's moving to the downside like this, it means that the Mag 7 is in control and that they are outperforming the broader market because their weight influences the S&P above and beyond everything else. When it's going to the upside, the Mag 7 is taking a break and that the weighted markets are underperforming the unweighted. So think about this for a moment. I'm not saying that one of these is going down and one of these is going up, right? RSP versus SPY. They can both be going to the upside, but we would be asking which one is outperforming. These are both up, but SPY is up more. When this situation happens, this ratio points to the downside. If we're going down, we would be wanting to ask the same question. Which one is outperforming to the downside? So to kind of represent that better, I built this chart. This one is a ratio. It's RSP divided by SPY, and it looks like that. That's what the ratio looks like. This is SPY, or it's SPX. But if you ignore the blue line for a minute and you just look at that pink line, it's just the SPX. So I put that on to ask, what's the S&P doing when this ratio is going up or going down or whatever? When I do that, you can see that when this ratio was pointed to the downside and we were dropping really far, that the broader market, the S&P was up. Same thing here. We were pointed to the upside. That was a bad example because everything was falling there. Let's find another shot. But the idea is with this thing, when we're going up in this, a lot of times it implies that RSP is outperforming SPY. It is not saying that the market is going down or up or anything else. Just weighted is doing better than unweighted. The funny thing is, though, while we're at it, if SPY is not the boss and RSP is, then we are going to fall in the broader market, right? So I should have just left that example on. When we go up because RSP is outperforming, the broader market typically falls. When we go up because RSP is outperforming, the S&P generally falls. That's usually the way it goes. But this whole thing was a ratio compared to SPY, and that confused people. So what I ended up doing was just setting both of those names on here. Think of it like this. This right here is just RSP. We could turn it into candles. You can buy shares in it because it's an ETF. It's just the RSP. And this is just SPY. You know what I mean? Like it's just SPY. If they'll show up here together. Come on, come back. Let's just add it. And as you can see, they're both going up. They're both going down. Even when it is a bear market and we are falling, they're both falling. And when we're going up, they're both going up. So this isn't about RSP is down and S&P is up. It's just about, hey, which one is in control or outperforming? When the S&P is outperforming, it's because of the Mag 7 and their influence. And generally speaking, when the Mag 7 is in control, the broader market tends to go up. That's fair. We are still in that situation, as you can see here and here. When this thing is pointed straight down, the Mag 7 is taking full control of the market, and they are in full control. Don't short this market when we're getting hyperscalers driving us to all-time highs. This is the weighted versus unweighted of the NASDAQ. So instead of doing it in the S&P, I'm doing it in the Qs. We had this really cool signal on Christmas Day, the very next week, the indicator started going up, which means the QQQ was underperforming the QQQE. But look at what price did in the Qs. We just kind of dallied along sideways, and then we finally broke down. But we didn't break down, until like mid-February. This thing started shooting to the upside right after Christmas Day. So it's the same logic, same rules. When this is going up, that's the Qs in pink. The QQQ is going up. This ratio is going down. And that's happening right now. So don't try to short this market in this scenario. It's a bad idea, right? It is worth noting that the Qs broke this high and we're like up here, but the ratio did not break this low and we're not down here. Technically speaking, we can go that much farther before we need to worry about the Qs having any sort of issue. Now, all things considered, this isn't saying that the Qs are going to continue to go up or that they have to go up to some XX target overhead. Just that if we're asking things like, is there anything we could hit or that could stop this market from continuing to move up? Yeah, the ratio could hit this resistance. Well, it's the support level down here. I call it resistance because this is inverse and we're moving this way. So if something is resisting you from moving that way, then it's resistance. But either way, we're not at the zone end, so this could continue higher. All of these tools are telling us don't short this market in front of all this weight and strength. But it is worth considering the fact that if you wait for confirmation, you have to pay for it. I know that can be a confusing concept for newer traders, but confirmation is not free. It costs you. And sometimes it's not worth the payment. You're better off just getting in without confirmation. Now, to each their own. I know a lot of people are taught to wait for confirmation before they get a trade. I'm not trying to teach bad habits or something. I'm glad to help. I hope I gave you guys something useful to ponder on over the weekend. I know a lot of traders ask when it comes to, getting the entry about waiting for confirmation. And depending on what you trade, you might not want to. You know what I mean? Like when it comes to options, I'm usually going the opposite direction of the market. So it's, going up and I'm shorting it, or it's going down and I'm buying it because that's the best options price with the least amount of risk. But that doesn't help you with winning and losing. It just helps you with how much you're going to win or how much you're going to lose. Two different things. It is after 4 though, so we made it to the weekend. Be a good place to stop unless anybody's got questions. We'll hit that and then we'll get the weekend started. We are going to be getting into a new quarter and a new month next week, which is a short week, by the way. So I'm thinking that when we come in Wednesday and, well, we won't be here Friday, right? Because that's the 4th of July. But when we come in Wednesday, that we can look for are we getting that quarterly refunding rebalance yet? And is there going to be any window dressing or not? Because that can be a little bit of an opportunity to get some longs on because we might get a bit of a pullback as they shuffle their money around. And then we can reevaluate what we're going to do for the next quarter. Yep. Everybody have a good weekend. I'll see you all on Monday. Don't forget it. It's a short week next week, right? So that is going to mess with premiums and all sorts of good stuff.